If you only remember one moment in your entire trading journey, remember this moment. The moment you increase size, not because the system requires it, but because you feel sure, not because of probability, not because of edge, but because in your head a very small sentence echoes. This time is different. And most traders don't die because of a stupid decision. They die because of a decision that sounded very reasonable at that time. You don't lose because you analyzed wrong. You lose because you bet too big on one time being right. There are old traders, there are bold traders, but there are very few traders who are both old and bold. Not because old people are timid, but because people who have lived long enough in the market have all witnessed a truth that newcomers haven't had time to see. The market doesn't kill you with a punch. It doesn't knock you out immediately. It slaps you very lightly over and over again until you go crazy yourself and then pull the trigger yourself. And the most dangerous part is, in the first slaps, you still think you're fine. You're still standing. You still have money. You still have confidence. And you confuse not being dead yet with being on the right path. This is how most traders get killed. Not loudly, not with immediate tragedy, but with a chain of small decisions that sound very reasonable. Many people believe that bigger risk means bigger reward. In life, that can be true. In business, sometimes true. But in trading, that belief destroys more accounts than anything else. Hit harder, win bigger. That sentence sounds so good. It sounds very masculine. It sounds like someone who dares to play big. And your brain loves that sentence because the brain is programmed to love explosions, to love quick rewards, to love a win big enough to make your heart pound, to make you jump up from your chair, to make you whisper, "I can do it." But trading is where that instinct becomes your enemy, because trading is not a right-wrong game. Trading is a survival game. You can be right 60 trades out of 100. You can still die if you bet the wrong way on 12 times. This is the part that many new traders don't want to accept. You don't need to be right a lot to live. You need to lose small enough not to die. But the ego doesn't like hearing that. The ego wants fast, wants a breakout, wants to get back to break even soon. And so, the aggressive approach sounds dangerously right. It whispers familiar lines into your ear. This setup is so clean, a rare opportunity. Entering small is a waste. One win on this and everything changes. And then you increase size. Just a little. No one increases 5x immediately. No one thinks they're doing something crazy. Just one more lot, just an extra 0.5%. Just because it feels so right. But that just a little is the moment you start handing control over to motion. You've heard this 1,000 times. Only risk 12% per trade. And very likely in your head, you once thought, yeah, but that's for people who are scared. I'm here to actually make money. I didn't get into trading to play it safe. I understand that feeling. 1% sounds boring. 2% sounds like crawling. It doesn't give you the feeling you're moving forward. It doesn't give you a story to tell. It doesn't give you a P&L screenshot to show friends. It doesn't give you dopamine. It sounds like you're breaking yourself, like you're leaving money on the table. But here's what aggressive trading will never tell you. When you risk big, you're not only increasing potential profit, you are increasing the emotional sensitivity of every decision. Risk 10% per trade. Just 5 losing trades in a row, a completely normal thing in trading, and you've lost nearly half your account. And that hit doesn't only hit your money, it hits your brain. You sit there staring at your balance being cut in half. And in that moment, trading changes the game. You're no longer thinking about making money. You're no longer looking for an edge. You're thinking only one sentence. How do I get back to the starting point? And that is an extremely dangerous kind of mind, because from that second on, you are no longer a trader. You are someone trying to get it back. Someone looking for a good setup and someone looking for a way to break even are two completely different people. A trader risking 1% per trade loses 5 trades, and it's only a light scratch. They lose 5%. Annoying, yes. Frustrating, yes. But they don't fall into a pit. They still have the ability to think, still calm enough to find the next setup. One person is trying to survive. The other is still trying to win. That is the entire difference. And if you still don't see how dangerous that is, look at the math. Math has no mercy. Math doesn't care how you feel. Down 50%. You need up 100% just to get back to the starting line. Not to get rich, just to not be down. Meanwhile, down 5%, you only need up 5% to recover. One person needs a miracle. The other just needs one decent week. This is not philosophy. This is math. And math asks you one cold question. After this drawdown, do you still have enough capital and enough psychology to keep clicking the button? Most traders die not because they're stupid. They die because they don't understand what the real game of trading is. Trading is not a game of who's right more. Trading is a game of who still exists after the losing streak. And losing streaks are not an if, they are a when. You can be very good. You will still have 5 losses in a row. You will still have 7 losses in a row. You will still have a very bad month. The only question is, does your risk structure turn that streak into noise or into a death sentence? Pause here for a beat. If you've gotten to this part and inside, you feel a bit uncomfortable, a bit resistant, a bit like saying, but I'm different, then that's exactly me touching the right spot. In part 2, I'll show you why traders die the most, not when they first begin, but right after the period when they traded fairly well, and why a winning streak is the most dangerous thing in a trading career. And that's why the most dangerous moment in the trading journey is not when you first open an account, not when you know nothing, not when you're still afraid to press the button, but when you've just had a winning streak. At that moment, your hands no longer shake. You don't doubt yourself as much anymore. You start seeing everything fall into form. You read charts faster. You see setups more clearly. You start to predict the market's rhythm. And in your head, very quietly, a thought appears that seems harmless. Looks like, I get it now. This is the moment when many traders start dying slowly. Not because they get worse, but because their confidence grows faster than their discipline. They haven't built a structure strong enough to carry that confidence. A winning streak does one very dangerous thing. It makes you confuse probability with yourself. You win a few trades in a row, and your brain doesn't think, this is statistics. It thinks, this is me. I can read the market. I'm different from the crowd. I'm not a normal retail trader anymore. And so, naturally, you start negotiating with risk, not the reckless kind, the very reasonable kind. This setup is better than the previous ones. The market is easy today. I'm in a good form. Bumping size a bit is fine. You don't break the rules brutally, you bend them. 1% becomes 2%. 2% becomes 3%. Then one very sure trade becomes 5%. No one thinks they're committing suicide in that moment. On the contrary, you feel like you're optimizing. And here's where trading is different from every other job. In most fields, when you do better, you're allowed to do bigger. In trading, that is the trap, because the market doesn't know who you are. It doesn't care if you won 5 trades or 50 trades before that. It doesn't reward confidence. It only cares about one thing. When you're wrong, how much do you lose? And then, like a law of nature, the losing streak appears. Not because you suddenly became stupid, but because losing streaks always appear. The problem is, this time you're no longer risking 1%. This time, each slap is heavier. The first loss, you're still okay. The second, a bit irritating. The third, you start thinking, it's fine, it's just a drawdown. But by the 4th or 5th, your brain switches modes. It no longer analyzes, it reacts. And from here, trading begins to deform. You look at the chart differently. You no longer see what's happening. You only see what you need to happen. You start hoping, start praying, start begging the market. You move the stop because it'll probably just sweep and go. You take profits early because you can't handle losing more. You skip a clean setup because just lost, I'm scared. And then you sit there wondering, why doesn't this strategy work anymore? But the painful truth, it's not that the strategy doesn't work. It's that you're no longer calm enough to execute it. Position sizing isn't just risk management, it's the psychology switch. The bigger the size, the more distorted the mind. No one can be objective when 10% of the account is on the table. No one can be calm when every tick against them is a knife to the chest. And that's why aggressive trading always leads to the same point. You shift from execution to reaction. And the moment trading becomes reaction, it is no longer trading. It's gambling. To make this even clearer, look at what professional traders are deeply afraid of, but retail almost never calculates. Risk of ruin. The probability of being kicked out of the game. You don't need to hit 0 to be ruined. You only need to fall to a level where your psychology no longer functions normally and you're already out. For example, you lose 150% of your account. On paper, you still have money, but in reality, you're afraid to click, you enter late. You take profits early. You move the stop, you no longer trust yourself. The account isn't dead, but the trader inside you is dead. And when the trader is dead, money is only a matter of time. This is why professional traders never ask, "How much can I make from this trade?" They ask, "If I'm wrong, how much do I lose? And after that, will I still be a normal human being?" That is the line between a long-term player and a gambler. And if you still think that I'm strong enough to handle big drawdowns, let's talk about the real cost of a big loss. Not money. Time. When you take a 50% drawdown, you don't just lose capital. You lose years of compounding. Even if you're very good, very disciplined, very stable, getting back to break even can take years. Not to get rich, just to break even. During that time, your money doesn't grow. You miss a major cycle, you sit out rare waves, you watch others go up. And this creates a very deep psychological wound, the feeling of being left behind. That feeling is extremely dangerous because it whispers, "Hurry up, risk more. You need one big hit." There isn't much time left. And that feeling pushes you right back into the old loop. Aggressive trading doesn't only take your money, it steals your future. It takes away years you could have been compounding steadily. While the safe trader looks slow, but they are always there when opportunity appears. And opportunity always comes. The only question is, when it comes, are you still alive to see it? In part 3, I'll tell you real stories about good traders, strong analysis, clean setups who still got wiped out for one reason only, position size. And I'll show you why Jesse Livermore, a legend, broke apart because of exactly what new traders treat as a small thing. And to show you that what I'm saying is not some air-conditioned theory, not a moral lecture for beginners, but a law repeated throughout trading history, let's talk about a name every trader has heard, Jesse Livermore. In 1929, he became a legend. He shorted the market right before the biggest crash in U.S. history. He made the equivalent of about $1.5 billion today. Pause for a second to understand how big that is. He wasn't lucky. He wasn't gambling. He wasn't blindly trend catching. He read tape well. He understood crowd psychology. He was ahead of his time. People wrote books about him. Other traders studied his every move. He was seen as someone who solved the puzzle. And then, just a few years later, he went bankrupt. Not once, but multiple times in his life. And here is where the story becomes terrifying. Not because he suddenly became stupid. Not because he lost his ability to analyze. Not because the market conspired against him. But because he started betting too big when he felt sure. He became careless with position sizing. He entered massive positions whenever he knew he was right. He confused a winning streak with being invincible. And worse, he started believing the old rules no longer applied to him. The market doesn't need you to be stupid to destroy you. It only needs you to think you're above the rules. And the market taught Livermore a ruthless lesson. He lost everything, not just money, but confidence, meaning, and eventually, his own life. Before he died, he wrote a sentence that still haunts the trading world today. "My life has been a failure." Let that sink in for a beat. A man who once made money most people can't even imagine, ended his life with 2 words, failure. Because of one thing new traders often dismiss, betting too big. Not strategy, not analysis, not setup, position size. And if you think that's a legend story, it has nothing to do with a retail trader like me, then I'll say it plainly. Retail dies even faster. Because retail doesn't have infinite capital, no credit, no support team, no ability to withstand big drawdowns. And here's what happens when you trade aggressively. You risk big, and you win. Your brain floods with dopamine. It feels incredible. You're not just happy. You're high. You feel smarter than yesterday. You feel ahead of the crowd. You start thinking, if this keeps going, I'm almost done. And your brain wants to repeat that feeling. So, on the next trade, you enter bigger. Not because the strategy requires it, but because you want that feeling one more time. Why not? I just proved I can do it. And then, you lose. Not a small loss. A loss that matches the bigger size. The pain of losing is always bigger than the joy of winning at the same level. Now, you're in a hole, and your brain screams an ancient command. Get it back now. You can't think clearly. You can't be patient. You just need to break even. Then you increase size even more because you believe one correct trade is enough. This is called revenge trading, and this is how most accounts die. Not because the strategy is bad, not because the analysis is weak, but because emotional decisions get triggered by positioning sizing that's too large. Safe trading pulls you out of this nightmare. When you risk only 1% per trade, your emotional reaction gets turned down. A loss is only irritating, not destroying. You don't fall into the spiral. A win feels good, but not high enough to make you stupid on the next trade. You keep a clear head. You keep logic. And in trading, logic is everything. The market doesn't care about your emotions, but emotions decide every choice you make. And here's an even deeper truth very few people are willing to face. You can have a very good system, but if your size is too big, you won't be able to execute that system like a normal human being. You will pray. You will hope. You will beg the market. You will move the stop because you can't endure the loss. You will take profits early because you need to breathe. You will skip a clean setup because you just lost and you're scared. Then you blame the strategy. This strategy doesn't work. But it's not that the strategy is wrong. It's that you've turned yourself into someone too unstable to run the strategy. When you're no longer executing and only reacting, no system can save you. And to show you this isn't just a legend story, here's a very real one. I used to be in a trading Discord community. There was a guy who started with $50,000, pretty good at identifying setups, not a newbie. The first 2 months, he won like crazy. The account went up to $71,000. And then the ego appeared. He started posting P&L every day, started talking like, I've understood the market. He increased risk to 8% per trade. Then he hit a bad stretch, lost 5 trades in a row. Completely normal. The account dropped to $45,000. And this is where the ugly part began. He panicked, said he needed to get it back, raised risk to 15% per trade, lost 3 more trades, account down to $26,000, total despair, started taking trades that weren't even part of the strategy, risked 25% per trade purely on emotion. Within 6 weeks from the $71,000 peak, the account was under $3,000. The last message he left, trading is impossible for retail. Then he disappeared. The most painful part? He wasn't a bad trader. Setups were decent. Analysis was decent. But nothing matters when you step into the death spiral. Big entry, big loss. Even bigger entry to recover. Catastrophic loss. Safe traders never enter that spiral. Not because they're stronger, but because they never take the first punch big enough to trigger panic. In part 4, I'll take you to the moment the whole market went insane March 2020 and show you why volatility always kills aggressive traders first, and why only those who survive have the right to make money on the rebound afterward. And if you think those stories are just exceptions, just human error, then look at a time when the ego of traders worldwide got crushed all at once. March 2020. COVID hit and the market went insane. Not a correction, not a pullback, real panic. Stocks dropped 20%, 30%, some 40% in just a few days. Circuit breakers triggered repeatedly. VIX surged to levels not seen since 2008. Price moved faster than any nice stop loss you've ever placed. Wild slippage. Gaps slicing through every technical structure. And this is where math starts eating people. If you risk 10% of your account per trade and you're on the wrong side, you don't lose 10%. You can lose 20%, 30%, even 40% in just a few hours. Not the position, the whole account, because stops get blown through. Because no one is buying. Because liquidity disappears. You click exit. There's no one on the other side. This is what new traders never factor in. Risk is not linear. In normal conditions, 1R is 1R. But in panic, 1R can become 3R, 5R. And big size turns that into disaster. A trader risking 1% per trade also gets hit. Don't misunderstand. They also hurt. They also lose money. But a 30% move against you with a 1% position, your account loses 3%. It hurts a lot. But you're still alive. And here's the most ruthless part. That crash didn't last for years, about a month, maybe 6 weeks. Then the market rebounded, and it rebounded fast. If you survived the first drop, the opportunity on the rebound was enormous. Safe traders survived and made big money on the rebound. Aggressive traders were already gone, sitting out, account blown, psychology wrecked, watching others get rich, and trying to figure out how to gather enough money to come back. Volatility doesn't care how confident you are. It doesn't care how good your analysis is. It just eats aggressive position and sizing for breakfast. And here is where I want you to pause for one beat. The market doesn't need you to be right immediately. It only needs you to be wrong once when you're betting too big. There's an uncomfortable truth most traders only realize after they've paid the price. Trading doesn't destroy you when you're dumb. It destroys you when you think you're smarter than the market. And the most dangerous moment is not when you first begin. It's when you've just had a winning streak. That's when you start believing you're different from the crowd. That's when you start believing the 1% rule is for other people. That's when you start negotiating with risk. Just this time, the setup is too perfect. Today the market is easy. One win, and I'm back on track. No one blows an account in panic right from the start. People blow accounts in a state of misplaced confidence. That's why so many traders die right after the stage of trading fairly well. Not because they got worse, but because they increase size before they increase discipline. There's a concept professional traders are deeply afraid of: risk of ruin, the probability of being kicked out of the game. You don't need to hit zero to be ruined. You only need to fall to a level where your psychology no longer functions normally, and you're already out. Losing 150% of your account is enough. Not because you're out of money, but because you're afraid to click, you hesitate, you take profits early, you move the stop, you no longer trust yourself. The account remains. But the trader is dead. And when the trader is dead, money is only a matter of time. Professional traders never ask, if this trade wins, how much do I make? They ask, if this trade loses, how much do I lose? And will I still be normal to keep trading after that? That is the question of someone who wants to live long. And if you still think that you can trade big for a while, then reduce it later, look at the price a big loss takes. Not only money, time to recover, time to regain confidence, time to dare to click again without trembling. During that time, the market doesn't wait for you. The big cycle keeps running, the big wave still comes, and only those who still have capital, still have psychology, still have discipline, have the right to participate. In part 5, I'll close everything with one very simple truth that is very hard to swallow. You don't need to win big, you need to lose small. And I'll give you a very concrete ritual, a 10-line checklist to cut off emotion right before you click the button. And now, after all the stories, the numbers, the crashes, the accounts that disappeared, come back to one very simple truth. You don't need to win big. You need to lose small, not to be safe, not to play for fun, but to survive long enough for your edge to have time to work. Trading doesn't reward the smartest person. It doesn't reward the deepest analyst. It doesn't reward the prettiest trade. Trading rewards the person who is still at the table after the losing streak. And here's the paradox most traders have to pay for many years to understand. Profit doesn't come from being right more. It comes from not killing yourself when you're wrong. The real winner isn't the one who dares the most. It's the one with enough discipline to not break the rules while waiting for opportunity. You can trade your whole life without one legendary win. That's fine. You don't need it. You need 1,000 trades where not a single trade has the right to destroy you. And when you understand that, trading starts to change shape. You no longer hope, no longer pray, no longer sweat looking at the chart. You don't move the stop because you can handle the loss. You don't take profits early because you don't need to gasp for air. You're not afraid of missing one trade because you know the market always gives another chance. Trading shifts from emotion to profession. And this profession has only one requirement: don't commit suicide. To do that, you need something very boring, not a strategy, not an indicator, not a setup, but a ritual to cut emotion off right before you click the button, not to look cool, but to protect you from yourself. Here's the checklist. Not read in your head, read out loud. If you don't read it all, you don't enter. No exceptions. Checklist before entering a trade. 1. How many percent of my account does this trade risk? Is it above 12%? 2. If this trade loses, will I still be calm? 3. Is this stop loss placed for a technical reason, or because I can't handle the feeling of losing more? 4. Am I entering because of the setup or because I want to get it back? 5. Is this trade according to the trading plan I wrote down? 6. Can I accept losing this amount of money without complaining, without bitterness, without revenge? 7. If I lose this trade, will I still be clear-headed enough to trade correctly on the next one? 8. Am I increasing size compared to normal? Why? 9. Am I rushing? If I miss this trade, will my life collapse? 10. Am I entering to execute the system or to prove who I am? If just one question makes you uncomfortable, you don't enter. That's not a limitation. That's a seatbelt. And then, over time, something very strange happens. Every trade you execute by the rules builds confidence. Not confidence because you win, but confidence because you are reliable. You are building a discipline record. You are proving to yourself that you don't betray yourself under pressure. Aggressive traders are building a different record. A record of panic. A record of hope. A record of regret. Even when they win, they reinforce bad habits. Winning trades are stressful, so the next trade is stressful too. The loop never stops. Over months, over years, the psychological gap between the two types of traders becomes enormous. One is calm, consistent, truly confident. The other is anxious, impulsive, unstable. Same market, same opportunities. Completely different experience. And now, remember Warren Buffett's 2 rules. Never lose money. Never forget rule number 1. He isn't rich because he's always right. He's rich because he doesn't get kicked out of the game. Trading is the same. You don't need to be right nonstop. You need to survive nonstop. Because the real winner is not the one with the prettiest trade. It's the one with enough discipline to not kill themselves while waiting for opportunity. And if right now you're still tempted by the feeling of go big to get there fast, ask yourself, very slowly, do you want to become a trader who's right once, or a trader who still exists after 1,000 times? The market always gives you another chance, but only if you're still alive to see it.